If you want to become a more successful property investor, today's show is going to point you in the right direction. In my first segment, I'm going to have a chat about where not to invest. You know, most of the time we talk about where you should invest, but this isn't just my thoughts. It's the results of findings from a recent university study in Australia that shows where you shouldn't invest. Now, we know that of the 2.1 million property investors in Australia, 1.9 million never get past their first or second property. So you don't want to be in that group. You want to be in the group of the 21,000 odd investors who own 6 or more properties, don't you? So you better pay attention to where to avoid investing so you don't fall into the same trap that so many others do. I'm going to share an interesting mindset message with you, and then I'm going to have a chat with Dr. Andrew Wilson, where we're going to say, hey, watch out for the first home buyers, because they're going to make a difference to our property markets. Now, if you're a first home buyer, this will be really relevant for you, but if you're an investor, it will be just as important for you, because first home buyers and investors are, in general, investing in the same price brackets and the same markets. Now, I'm sure you've heard about the first home buyers incentive scheme that's going to be starting soon, but we've got some concerns about it. It was an election promise, but is that going to imprison a whole group of new first home buyers as the government props up the Australian property Ponzi scheme? Well, they're not my words, but they are the words of a prominent commentator. To get a better understanding of what's going on, I'm going to have a chat with Dr. Andrew Wilson, because we do have some other concerns. And what we're going to look at is what happened when we had these schemes in the past. You may not realise, but the last big property boom that started in 2011 was initially fueled by a similar first home buyer scheme. I think you're going to learn something in my chat with Andrew. So, welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
I'd like to spend a moment talking to you about where you shouldn't invest if you want property investment success. Now, we know that most property investors don't achieve the success they want. There's over 2.1 million property investors in Australia, and 1.8 million of those never get past their first or second investment property. At the other end of the extreme, about 21,000 investors who own 6 or more properties. 1.8 million? 21,000. What are those who are doing well in property investment doing differently to the average? Well, recently, a survey showed that 2/3 of property investors make the mistake of buying in their own backyard. The survey, published by the University of Tasmania and the University of Sydney, a couple of lecturers there, did an intensive study and found that 2/3 of Australians buy an investment property picked close to where they live rather than in another location that may well have outperformed their hometown in the long run. In fact, the report said the explanation for this home-based bias is a familiarity bias, but it's also a lack of sophistication, knowledge or education, and that's one of the reasons most investors don't do well. The report also showed that there was no evidence that location familiarity gave these buyers an informational advantage. Now that's interesting. You've often heard me say that knowing your local area is not the same as understanding the dynamics of the local property market or understanding what does or doesn't make a good investment property. Now, sure, proximity to an opportunity for property investors cut down their time and their effort when they were investigating, when they were researching the property. But to become a successful property investor, you do need to put in time. You do need to put in effort. Or maybe you don't. Maybe somebody else has to. And that's why more and more investors are turning to buyer's agents who've got a wider spread of market knowledge and who can bring some information to the party. Another Interesting but scary statistic that came out of this report was that 1/5, 20% of investors were self-managing the properties themselves. That's probably part of the reason they wanted to have one close to where they live. In my mind, that's a recipe for disaster, because employing a proficient property manager, that's not a cost. It's an investment. It's a form of insurance to protect your asset. Now, I'm sure those investors who bought locally thought putting all the eggs in the one basket was doing the right thing. I mean, no one wants to do the wrong thing. They probably thought it felt safe. The problem is having a number of assets in the one location, in the one geographic location, is potentially a high risk. Now, the report also found the inclination to invest close to home meant investors, interestingly, were paying a lot more for their second or third property in that same postcode. The report said, we found to our surprise that investors who invest in our own area pay much higher prices, although they couldn't actually see about the quality of the property that the people were buying. But it went on to say, and we argue they may not be getting the highest return, they're overconfident of their local area, and that's where this home bias comes in. So you've got to choose an area that's going to outperform the averages. And that's not because you live there. Not every property makes an investment property. Well, it can. You can just kick the landlord out and put a tenant in, and then it is an investment property. But it's not an investment grade property, not one that's going to outperform the averages. You've also heard me say that location does 80% of the heavy lifting. So just because you know an area doesn't mean it's the right place to invest. So if you're looking at buying your next home or your investment property, why not spread your wings? Now, you may say, but I don't know other areas. I don't know other states. That's okay. That's where my team at Metropole can come and help you. Sure, our property markets are improving, but still, the correct property selection is going to be critical to your success. So we can help you in a number of ways. We may be able to just give you strategic advice. Why not allow us to build a strategic property plan for you and your family? Planning's bringing your future into the present so you can do something about it now. You can always use our buyers agency. We've been involved in over $3 billion worth of property transactions, creating our wealth for clients. But interestingly, we've got our own offices in Sydney, Melbourne, Brisbane, so we don't fly in and fly out. Our buyers agents, who implement the strategy that our property strategists put together, they know the local markets. They're there all the time. So you're not going to make the mistake of just buying in your backyard. So we'll help you find your next home or your investment property. Go to metropole.com.au or give us a call on 1300 Metropole. I'd love to be part of your wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's Mindset Moment, I'd like to remind you that almost nothing is as bad as we think. One of the reasons we tend to procrastinate is because of fear, and that's largely due to our prefrontal cortex exaggerating the feeling that certain events are going to be much worse than they are actually going to become. But if you just knew how resilient you are towards life events, you'd take more risks, because almost nothing ends up being as bad as you think it's going to be. Your brain's incredible ability to adjust was proven in a famous experiment in 1978 by researchers from Northwest University and the University of Massachusetts. The experiment studied happiness levels from two very different groups of people. The first group consisted of recent lottery winners, and they got prizes anywhere between $50,000 and $1 million. The second group consisted of victims of accidents which caused them to become paralyzed. Gee, quite some contrast. The researchers interviewed each group to measure the level of happiness they felt in their day-to-day lives. Predictably, lottery winners had a much higher present level of happiness. But the surprising finding was that the victims measured slightly higher levels of long-term happiness in their daily life. The conclusions drawn from this study proved that traumatic events actually have a limited effect on our overall happiness once we adjust. This is why risks are not so scary once we take them, and why worrying, well, that's just really a misuse of your imagination. The key lies in your ability to adjust your expectations when things don't go right. And I know, they don't always go right. It's natural to feel that you're going from heights of exhilaration to the depths of depression after not getting a deal or losing a relationship or losing a job. But the danger lies in getting stuck in a prolonged state of unhappiness and letting one moment of unhappiness affect how you're going to perform in other areas of your life. The key to having consistent performance in your life, in your property investment, is managing your emotions. Going from neutral to happy isn't the challenge. The challenge is flicking the switch from unhappy to neutral. Master this as a daily habit, and you can move from fear to freedom. Watch out, here come the first home buyers. It's quite likely the number of first home buyers in the market is soon going to reach the highest level since the Rudd stimulus of over a decade ago. That was part of their package to stave off a recession in Australia during the global financial crisis. First home buyer numbers have already increased significantly over the last few months, and now the federal government has released further details relating to its first home loan deposit scheme. Now, in my mind, this is just fulfilling the election promise of rescuing first home buyers, but already some people are suggesting it's just another example of the government propping up a property Ponzi scheme and leading another group of young, unsuspecting Australians into economic imprisonment. So to get a better understanding of what's going on, let's have a chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of myhousingmarket.com.au. Hello, Andrew.
Good day, Michael. How are you?
Good. Now, Andrew, you've recently written about the large number of home buyers who already are in the market before this scheme has moved on. Tell us what's going on, please.
We've seen a rush to market, particularly in New South Wales, Michael, from the middle of the year from first home buyers. And we shouldn't be surprised because higher house prices are poison to first home buyers. We've certainly seen a revival in prices growth in Melbourne and Sydney. And first home buyers obviously perceive that as prices are rising, it makes it harder for them to get into the market because they have to save their deposit. And in certain circumstances, prices can be rising faster than their capacity to actually save the deposit. So they're keen to get back into the marketplace while prices are still notionally low. They're still lower than where they were 2 years ago. And we've seen some very strong results, particularly in New South Wales. The August ABS data for first home buyers was the highest monthly total we've seen since December 2011. And of course, that's when there was a rush into the Sydney market because of changes to stamp duty, which had a sunset clause that ended in 2011. And we had a lot of first home buyers rushing in to take advantage of that. It actually was the genesis of the great Sydney boom, all those first home buyers, because they were buying established properties. And that created that sort of ripple effect through the marketplace, which was energised with lower interest rates. And we've also seen the average first home buyer loan rising by 11% over the year. So first home buyers are paying or also happy to pay more to get into the market. Similar strong results from Melbourne are not quite as strong as New South Wales, the Victorian data. And if that's up 4%, first home buyer average loan is up 4% in Victoria. First home buyers have the wisdom that a lot of our commentators sadly lack, and they just ignore a lot of that garbage that's promoted, such as you suggested, the Ponzi scheme, and the first home buyers will celebrate a lot more, are celebrating becoming homeowners.
One of the challenges for first home buyers is affordability, but with interest rates low, that's not as big a challenge for most as getting a deposit, saving up the 10% or often 20% deposit. Some have gone to mum and dad to get a hand with that, but at the election, the Morrison government promised to give first home buyers a leg up. And so from the 1st of January 2020, their new first home loan deposit scheme is going to allow first homeowners to just put down a 5% deposit rather than the usual 10 or 20%. And it's going to mean that they're not going to have to pay lenders mortgage insurance. Now, we knew it was only going to be available to 10,000 eligible first home buyers, but recently there's been some more detail given. It means that in Sydney it's going to be capped at property for 700,000. In Melbourne you can only use it for a property up to 600,000, 475 in Brisbane, and it'll apply to owner-occupier loans with a principal and interest loan. Price caps are going to also be similar for Gold Coast, Newcastle, those regional areas, Geelong, close to their own capital cities. So it removes the need for first home buyer to have lenders mortgage insurance, which actually saves people a little bit of money. But you mentioned a moment ago it was the beginning of the boom a while ago. I remember last time when there was a first homeowner grant along these lines, I called it a second homeowners grant because what ended up happening was established home buyers put up the value of their properties, and it led to a rising property market, particularly in Sydney, but then also in Melbourne. So are we going to have the same again? That's, I guess, where some people were talking about a Ponzi scheme.
Well, it's not a Ponzi scheme, Michael, because the value of the property is the value of the property. And going forward, if there's more demand with fixed supply, that's the nature of the beast. I don't think that the misunderstanding what a Ponzi scheme is. There's nothing artificial about more buyers with fewer notional sellers, and people can only pay what they can afford to pay, and that's restricted by bank lending conditions. And the only difference here is they don't have to pay mortgage insurance, which, Michael, typically can be $12,000 to $15,000, but that mortgage insurance usually is loaded into the loan, and they pay that off. The whole point is, if you borrow a higher proportion, you have to have the income to be able to support it, Michael. So it's one thing to say, oh, great, I can buy a house with 5% deposit, but you then have to have the capacity to repay 95% of the loan. We've got to understand this policy was created during an election campaign. During that period, we had a market which was under pressure. Prices were falling. There was a lot of negativity about the market. It's almost an urban myth regarding first home buyer participation in the market, which actually was quite reasonable as prices fell over the past 2 years. And we had some changes to stamp duties for first home buyers in New South Wales and Victoria. So I don't think we needed the policy. But of course, then it was a political decision, and that's why immediately the ALP agreed at the time to the same policy. But of course, the market's now turned on its head since then. Prices are rising. First home buyers are rushing into the market, particularly in Melbourne and Sydney.
Another argument some detractors are making is there's 110,000 or so first home buyers in the market each year. This only applies to 10,000 people. It's only a drop in the ocean. It's not going to make a difference, Andrew. What do you say to that?
Well, that's nonsense, Michael, because yes, it is only 10% of the total load or first home buyer activity over a year. We get around about 10,000 first home buyers every month. And now we may see that double the first month if it rushes in. It is a first in, best dressed policy, and we're going to see a rush to market, and we're going to see a lot of activity in particularly those price areas where the caps are, Michael, up to 700,000. So it's those lower to mid price range areas that will benefit from what will be a surge in first home buyers. I think we'll get a lot of Melbourne and Sydney first home buyers taking the lion's share of that 10,000 first home buyer opportunities. And I think that's going to really work to push up prices strongly in Melbourne and Sydney. And this, of course, is the worst possible news for those first home buyers who miss out. And as I've called, Michael, this now is looking like first home lotto. If you get one of those 10,000 places, whoopee. And if you don't, you're going to be paying maybe 10% more for your property down the track and having to wait maybe for the following year to try to strike it rich in 2021. So it's, again, not a well thought out policy. And as we always see with demand side policies, create more problems than they solve, as we saw with those APRA policies. And I think we're going to see a similar result of a surge forward, and then with pent up demand released, and then nothing much happening afterwards.
Well, I'm sympathetic to first home owners having trouble getting into the market. I've got children and grandchildren. You have also, so we understand it's never been easy. Having said that, though, the restrictions for this first home buyer scheme mean that you have to, as a single person, have an income of 125. Couples, it's a combined income of 200,000 per year. So it's actually not aimed at the poorer people in our economy. One of my questions would be, why is a couple earning $200,000 a year not yet got the financial discipline to have saved a deposit? And if they haven't got that, when they buy a home, are they then going to go out and get the latest furniture and appliances on those interest-free 3-year packages, and down the road find themselves in hefty debt, paying double-digit rates because they haven't actually yet got a savings discipline, Andrew?
Well, I don't know, Michael. I think that it all works out fine, but it will, I believe, create a surge into the market in the short term, which will push up prices, which is bad news for those first home buyers who miss out. They should have left well enough alone. We have seen first home buyers coming into the market in significant numbers, irrespective, and we're just going to create another ripple, another wave effect through a poorly thought out demand side policy, when in actual fact, governments would be much more prudent to be focusing on supply side policies. If you want more first home buyers in the market, just build more houses.
So the old story, be careful of the unintended consequences of politics interfering with our property markets. It'll be interesting to see which way this pans out. Thanks for your time again, Andrew. Look forward to catching up with you next week for our regular weekly Property Insider Chat.
Thanks, Michael.
Some interesting thoughts from Andrew Wilson, and I hope now you understand where you shouldn't invest. Don't invest in your backyard. I know it's a bit scary going afar, especially to another state, and it's a bit scary for many beginners to trust somebody else to help them because you can't do it on the internet. It's too hard to do from a distance, and even in your own state, if you've got to invest in a different patch, you need some professional advice. Not just a buyer's agent, because buyer's agents are biased. You need more than just a buyer's agent and probably a property strategist. You need somebody who's going to give you some holistic information, guidance, strategy, work out where you want to be and help you get there. And that's what my team at Metropole does. Now, if you got some benefit from today's show, I'd really appreciate it if you told a few people about this. Pass the message on, because just like I'm trying to help you become a more informed investor, I'm trying to help as many Australians and people from overseas become more successful in all areas of their life. So use the share button on your podcast app or just tell somebody about it. And if you tell the world about it by leaving a review on iTunes or Stitcher or wherever you listen to this, and I read it out, I'd love to say thank you by gifting you one of my books. All you have to do is email me, michael@metropole.com.au, and I'd be happy to give you a gift. Like I'm going to O Investments, who left a review on Apple Podcasts saying, ready for the next level. He said, or she, I'm sorry, I don't know who O Investments is. I shouldn't make assumptions, should I? They said, this podcast provides great insights into the everyday habits which everyone can develop and implement to take their financial, professional and personal goals to the next level. Michael breaks it down into such simple language which is easy to listen to and gives you direct applications for day to day. While property is his passion and area of expertise, Michael's grown his knowledge across a vast variety of skill sets through his conversation studies and programs. I look forward to tuning in to each episode and finding out what I can take away and apply to my life. Keep up the great work, Michael. I look forward to the day I can get into some investment property and know that I'd head towards Michael's training program when the time comes. Well, thank you so much, O Investments, and you will be one step further forward when you email me and get a copy of one of my books. You can choose which one. Now, in between the podcast, if you want to learn more about success, property, tax, finance, and get guidance from Australia's leading range of experts, go to my daily property update newsletter, propertyupdate.com.au, and follow me on social media. And more recently, I've been on Instagram and I'm having a lot of fun there. So I'd like to find out about you. Join me. Just look for Michael Yardney on Instagram or Facebook or Twitter, and we'll keep in contact. I look forward to catching up with you again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?